This is Daybreak Asia. We're counting down to Asia's major market opens. We are seeing broad upside, Paul, when it comes to this equities trading session. Of course, bonds under pressure. Treasuries really starting off on the back foot, and we're seeing these yields hitting those 2024 highs.
Yeah, the 2-year edging ever closer to that 5% level, so we'll keep a close eye on that today. And we've been hearing a little bit from the the Ministry of Finance again, Shinichiro Suzuki, about possible intervention, but it's really a retread of those old lines. But as the yen keeps on weakening, maybe today's the day.
It does, and we spoke to Nab a little bit earlier about when that intervention could come, and really, I guess, the sensibility of the fact that they may want to wait until after that US inflation print. If there's much buying, then wait for that to kind of wash out, if you will, before, if they in fact need to do significant intervention. But let's take you straight to the market opens. We are expecting a pretty solid setup here, and in fact, Japanese equities just extending those gains about 0.4% higher for both the Nikkei 225 and the Topix. So we're watching a lot of the commodities and then energy-related names. This is oil, this is the likes of iron ore, and a number of other commodities just continue to clock in those gains. Dollar yen, as Paul mentioned, hovering just under that 152 level. 151.83 is where we're sitting at. So it has been pretty stable for the past few sessions, and of course maybe a bit of sideways trading as we get into that US inflation print, which could potentially worsen that gap between the Fed and the BOJ. Right, we're also seeing a little bit more conviction perhaps when it comes to timing around when the BOJ could be moving. This is Governor Ueda kicks off his first anniversary under his belt at the helm of the Bank of Japan, having dismantled, of course, this huge stimulus experiment. The question is, what is next? That 10-year JGB is also looking to see a bit of a reaction from what we've seen across Treasury markets there as well. Take a look at Korean markets, and of course politics is in focus there, as the election there really hinging on what urban voters and how voters there will respond to the macroeconomic outlook and these inflation pressures as well, right? As we see polls indicating that top issues have been tackling into inflation, household wealth and the like. We're seeing costs be up by about 0.5% there. Tech stocks also doing quite well, with the Kosdaq up by about 0.5%, and watching dollar won given the recent weakness, but of course a lot of that recent weakness, Paul, across broader Asian FX, not just the yen.
Let's take a look at how we're doing in Australia as well. Market has just opened for trade here and moving modestly higher in the early going, just a couple of minutes in, so a number of names still yet to begin trading. But interesting, already we've got materials among the best performers, and we have seen a recovery in the iron ore price. That's back above $100 a tonne. Of course, we have had some encouraging signs of demand coming out of China, so that's helping to support that. We've also got Brent crude starting to trade again, and that is also moving higher. Notwithstanding Israel's decision to withdraw some troops from Gaza, a lot of that supply and demand picture remains very much intact. Yields here in Australia climbing just a little. The Aussie dollar pretty stable at 66 cents. But let's take a look at how US Treasuries are trading in Japan at the moment. Yields climbing a little bit for the 10-year, and yields for the 2-year were initially higher, just easing back a little bit now. But one of our questions is when could potentially that 2-year yield hit 5%? 10-year did touch or got close to 4.5% in the US trading. That's sort of seen as a level where the rates really could start to break out and test those highs that we saw in 2023. That's the highest since we've seen since November last year. Markets, of course, now leaning towards the possibility of just 2 rate cuts this year from the Fed. And in that regard, we've got Neil Kashkari, the Minneapolis Fed president. He's been speaking earlier. Let's have a listen to what he has to say.
The labor market is not red hot the way it was a year ago or 2 years ago, which was just crazy hot, and they had to keep paying up to keep their workers in place, let alone trying to find new workers. So it's not that red hot, but it's still a tight labor market. They're still having to compete to find workers.
All right, let's get to Joshua Crabb now. He's head of Asia Pacific Equities at Rebecca, joining us from Hong Kong. Joshua, I want to start with those remarks that we've heard from Neil Kashkari. Of course, this is the Neil Kashkari who a few days ago was suggesting maybe we don't get any rate cuts at all this year. He's still talking about how the data in the US is pretty strong. Where do you stand in terms of your expectations now? Have you repriced, reassessed?
Well, I think the view from our macro team has been pretty consistent over the course of the year, and that has been for sort of 2 to 3 cuts. Clearly, earlier in the year, the market was looking for almost double that, and now it's sort of come back to that sort of that similar sort of range. So I guess we're not that different to the rest of the market now. I guess our sort of backdrop is we have a lot of inflationary pressures, whether that's energy transition, whether that's labour force, whether that's supply chain diversification, and from that perspective, we think that you end up with a more elevated sort of level of inflation for some time. Now, clearly the market is hoping that will come back, and we'll see the rate cuts that will stimulate the market. But I guess the positive side of the offset of that is that growth has been a lot better in the US market. So we sort of feel that we're not that indifferent to the market at this stage.
Well, we are seeing yields rising. We had that screen up when you were talking just now. The 2-year, perhaps an exception, though. But when you look at this chart on the Bloomberg, we do see the trend for the 2-year starting to push towards 5%. Can you see a scenario when we cross that, and when might that be?
Yeah, I mean, I think this is where it's always interesting to sort of step back a little bit. It wasn't that long ago, when people thought interest rates were going to stay around 0, and now we've moved up to sort of like a level that seems, more consistent with the inflationary environment we're sitting in. So I guess for us, the sort of debate whether it's a little bit higher or a little bit lower is probably less important than thinking about how many cuts are going to come. So that's going to come down to what we're sort of seeing out of US growth. It's going to depend on what we see out of the US labour market and that sort of wage growth going through. So for us, it's probably less of an issue now than it was, say, a couple of years ago from that inflationary perspective. And again, I think the biggest question here is what is going to happen, with the US growth and with that inflation that's happening from the wage perspective.
Joshua, Japan has obviously been so popular, but we've seen over the last few sessions maybe a loss of momentum for the Nikkei 225. Do you think there are more downside risks of potentially lower guidance from companies, potentially a strengthening in the yen, maybe some of those flows being redirected back to China?
Yeah, look, I think this is one of those really interesting questions. I think, if I was sitting here, or when I was sitting here a year ago, we were quite optimistic on Japan, and that's a market that has done quite well. So it's definitely not contrarian to be optimistic about Japan anymore. Now, that being said, I think we saw a lot of the sort of fast money enter into Japan, and we saw some of that money taken off the table going into year-end last year. I think what's been interesting in the strength that we've seen in the beginning part of this year has been for more longer-term investors coming into that market. Now, from a corporate perspective, clearly a lot of the companies are not assuming that the yen is as weak as it is now. So I think there is a little bit built in for even some strength from here. Ironically, if the yen does stay here, we'll probably have the potential to see some upgrades as well. So from our perspective, I think the yen has probably run the majority of its course in terms of its weakening. But we don't think that destabilizes the story, because if we were to see strength in the yen from here, that would definitely change maybe some of the leadership from some of the exporters to some of the more domestic sectors. But we don't think it changes the story for Japan. And a lot of that is around restructuring, it's around simplifications of businesses, it's around cross-shareholding, unwinding, etc. So we think that story continues to remain. One other aspect of that I think is interesting in terms of new catalysts, we've seen a lot around the wage negotiations. That's had a big impact on inflation. But as people start getting those increased wages hitting them, the question is going to be, where does that go? Does it go into consumption? Does it go into real estate purchases? Does it go into financial products? But that money will need to flow somewhere. Clearly, it's been it's a very different person that in Japan today that is going to be getting those wage increases than when we last saw this 20 plus years ago.
Korea, if Japan's path is anything to go by, Korean stocks have a long way to go, right? Where do you think is interesting when it comes to Korean markets at the moment, and what do you think the implications are of the upcoming election?
Yeah, I mean, I think this is a great sort of analogy coming after Japan, because if we sort of think about, Japan a year and a half ago, no one believed that these changes were happening. And I think for a number of the same reasons, the aging population, the sort of the drive coming from the stock exchange or whatever else, we're seeing something very similar. Now, clearly we saw an immediate market reaction to this that is now sort of stabilized, as I guess some people have taken profit and are waiting to see the execution on this. So I think this is going to be a really important point to sort of sit back, look at the companies that will affect that sort of change. The elections will matter in this. The current ruling party is definitely pushing for the value up, for lack of a better name, of what's happening in Korea. So we do think that the election will matter, only a couple of days away now. But we do think there will be a lot of opportunities. Korea is one of those markets. People have often talked about the Korea discount. There are various reasons for that. But, seeing increased buybacks, increased dividends, increased shareholder-friendly sort of activity will definitely create some opportunities, in the Korean market.
There's some interesting moves across EM more broadly, right? We see a lot of weakness across Asian FX. You see maybe a stabilization in China, and maybe I'm wondering if you see more investable opportunities there. But are you looking at emerging markets in Asia?
Yeah, absolutely. I think you need to look at the sort of world in a bit of a backdrop here, and FX is an interesting start. Clearly, I'm an equity person, but even when we're talking about the yen or what the BOJ may or may not do, you're talking about 10 basis points here or there. So when we think about the changes in expectations in rate cuts in the US, it dwarfs those moves. So really, I think a lot of the FX and the rate environment is being driven by what's happening with the US and those expectations around growth and inflation rather than what's happening here. But if we take a step back and look at the natural growth in economies, if we look at a lot of Southeast Asia, Indonesia, Vietnam, the Philippines, these will continue to be very, very medium-term, strong growth stories. So we think there are a lot of opportunities sitting there. You touched on China. Again, this is probably the sort of the elephant in the room about what's going to change there. We probably don't see any wholesale changes in terms of a lot of the, what people see as the long-term headwinds. But clearly the market is starting to stabilize in terms of the stock market, also the economy as well. And what we think the interesting aspect there is if we look at a number of companies, we are seeing, some of these companies starting to now beat very low expectations. We're seeing an increase in terms of things like buybacks and dividends. So we're seeing a lot of things that we do think should be supportive, but that will probably be more at a stock level for the Chinese market.
Joshua, great to chat with you as always. Joshua Crabb, who's the head of Asia Pacific Equities at Robeco. Take a look at some of the stories that we're watching. Defense stocks in Japan are in focus, the likes of Hosoya. We're also seeing Hua Machinery there as well. Not much of a change, actually. We did see some, really when it comes to the visit that we've seen from Japanese Prime Minister Kishida meeting with President Biden, and this talk about potentially, at least in the second part of the AUKUS agreement, having Japan involved as well. We could potentially see a little bit more of a move there, but we're not getting a great deal of details in terms of how that would play out. Taking a look at chip stocks as well. This is the picture as we look at the likes of some gains that we're seeing across Tokyo Electron. Renesas up by 1.3% there as well as SK Hynix seeing more modest gains. TSMC getting that $11.6 billion in US grants and loans for chip plants as well. So we're seeing some of that associated optimism. But of course, Paul, interestingly, we did hear from Elon Musk talking about that sort of feverish demand, perhaps, when it comes to AI-related demand starting to pass for chip demand.
All right, still to come. Let's talk about the Bank of Thailand is facing government pressure to cut rates, with the Prime Minister insisting inflation is low enough for easing. We'll have a preview of Wednesday's decision coming up later this hour. Also, Janet Yellen wrapping up her China visit with a warning against any aid for Russia's war in Ukraine. Details of that next. This is Bloomberg.
We continue to be concerned about the role that any firms, including those in the PRC, are playing in Russia's military procurement. I stress that companies, including those in the PRC, must not provide material support for Russia's war, and that they will face significant consequences if they do.
US Treasury Secretary Janet Yellen, they're wrapping up 4 days of talks in China with a warning against any moves to bolster Russia's military capacity. Our Chief North Asia correspondent Stephen Engel joins us now for more. So, look, I think Janet Yellen got across the points that she wanted to make. Arguably, we haven't seen much of a reaction in terms of progress being made from the Chinese side. But how do you rate the impactfulness of this trip, I guess?
Well, these kinds of trips, and by the way, this is her second trip to China in the past 9 months, so that's a good sign that they are talking. But deliverables are hard to measure, obviously, when you're trying to build up trust between two, I would say, competitive adversaries in the global space in many different realms. So, Janet Yellen was there, and we already kind of knew that she was going to go to Beijing in her 4-day visit and talk about excess capacity, in particular in those new industrial efforts by Xi Jinping. I'll get to that in a minute. But she kind of capped off the trip yesterday with that warning we just heard about any banks, including those in the People's Republic of China, that facilitate significant transactions that channel military or dual-use goods to Russia's defense industrial base, expose them to the risk of U.S. sanctions. And the ultimate weapon, I guess, would be cutting off from the U.S. dollar. That would be an extreme case, like what we've already seen over the last couple of years with Russia. But it comes at an interesting time, her comments about Russia and Beijing's, relationship at the time of 2 years of war in Ukraine, because Sergei Lavrov, the foreign minister of Russia, also arrived in Beijing on the same day. Now, Yellen did say most of the trade that has obviously surged between China and Russia is non-problematic. The key, though, is finding evidence, if there is any, of goods, dual-use goods or military hardware that is going to feed the war in Ukraine.
Steve, in her press conference, Janet Yellen also said the global economy may be adversely impacted by these ramped-up factory exports that we're seeing from China. So did Beijing have a response to that?
They have had a response. I mean, for the most part, Beijing has played nice, according to the sources at Treasury Department who are in those talks. They have listened to Janet Yellen, but what is Beijing supposed to do? Xi Jinping has given the marching orders to basically unleash new productive forces. That would be in electric vehicles, in batteries, in solar capacity, and the like. And when you have that kind of mandate coming from the top, there is excessive, in some estimation, buildup of excess capacity. And where does that need to go when the Chinese economy is slowing down? It would go abroad, according to Janet Yellen. So she made that warning about dumping and flooding the market with cheaper subsidized goods under Xi Jinping's industrial mandate. But again, what is Beijing going to do when consumer confidence and consumer spending and the domestic economy is sputtering? So again, there's going to be a lot of debate on this going forward, as it's an election year in the United States, and Donald Trump, of course, threatening further tariffs on Chinese goods if he were to come back to the White House. The Xinhua News Agency, you asked about China's response. Xinhua News Agency, in a commentary Friday, essentially said they blasted Yellen's xenophobic narrative of Chinese excess capacity. It says it smacks of creating a pretext for rolling out more protectionist policies to shield U.S. companies. We also heard from the the Vice Finance Minister, Liao Min. He pushed back, saying the current production capacity is far from meeting market demand. He was talking about the green tech energy products like batteries and also EVs, which I believe Peter Elstrom is here to talk about after me.
He is. We'll get to him in a moment. All right, Chief North Asia Correspondent Stephen Engel there. Thanks so much. We're going to have more on the impact also of Janet Yellen's visit to China in just a few minutes with the Asia Society Policy Institute. That conversation with Wendy Cutler coming up shortly. But Steve did mention TSMC there. US-listed shares gaining after the Biden administration announced almost $12 billion in grants and loans to help build chip factories in Arizona. So for more on this, let's get to our executive editor for Asia Technology, Peter Elstrom. So, Peter, very significant. Walk us through the details.
It is a significant award from the U.S. government. The Biden administration, of course, has passed this CHIPS Act where they're giving money to various players in the semiconductor industry to try to build up what they now see as a very strategically important industry. Well, TSMC is the most strategically important of those chips companies. It makes the most advanced chips. In particular, it'll make the chips for companies like NVIDIA, the AI chips that train ChatGPT and other kinds of models. models. It also makes the chips that go into the latest iPhones. So being able to land this deal with TSMC and help them develop sophisticated chip plants is a very significant deal. The U.S. government is giving $6.6 billion in grants to TSMC, and then at least another $5 billion in loans as the company builds these fabs. One of the surprises that we found out is that TSMC already has agreed to build 2 fabs in Arizona. It's now going to add a third on top of that, and this third fab is going to make the most sophisticated chips that we've heard so far. They're what are called 2-nanometer chips. Right now, the current state of the art is 3-nanometer chips. They're going down to 2-nanometer chips in the U.S. That's important because they need to be able to make these more advanced products that are going to help drive innovations like artificial intelligence, electric vehicles, and that sort of thing. So that's going to be very important for the U.S. economy. Of course, awarding the money is one thing. They still need to be able to get these construction projects done, and that's been a little slow in the U.S. so far.
You've talked about some of the reasons in terms of the types of chips that they want to have access to. What is the broad ambition here in terms of why the government is allocating so much funding for this industry?
Well, there are a couple of things going on, partly because of the COVID pandemic and the disruptions that we saw to the supply shock. Governments around the world saw how risky it was to not have access to key components, particularly semiconductors. The most advanced semiconductors right now are really made in Taiwan and a little bit more in South Korea. Those are really the 2 countries that are so key. So when supply chains get disrupted, that can cause a lot of problems. In COVID, we saw auto manufacturers having to shut down operations in Japan, in the United States, in Europe, because they couldn't get a lot of the chips that they wanted. On top of that, we have rising geopolitical tensions between the U.S. and China. So the U.S. government, like the Japanese government and the European governments, have decided that semiconductors are strategically important to their economies, that they need to have some sort of domestic supply so they'll be able to continue those supplies if anything happens like what we've seen in the past. So the U.S. has actually been a little bit behind, say, Japan. Japan was very quick to kind of move ahead with these programs. It also courted TSMC to come to Japan and build fabs there. They've already built one of the fabs in Japan. It's not as sophisticated as what we're seeing in the United States, but they were able to move very, very quickly there. So the U.S. is playing a little bit of catch-up here, but it's a good sign that now they have TSMC on board. They've already allocated money to Intel, the big American chip company, the most advanced of the chip companies in the United States at this point. And then on top of that, they're courting Samsung and some other players here with the hopes that they're going to be able to build a critical mass of semiconductor capabilities to help the economy in the future.
Yeah, what's it going to mean for the U.S. economy, all this investment in the cutting-edge chips?
I'd say first and foremost, it's going to mean jobs in these construction projects. Part of the money that TSMC is getting, for example, is going to go into training workers. You're going to get 20,000 construction jobs and then 5,000, 6,000 high-tech manufacturing jobs on top of that. So there is a hope that this is going to create some sort of benefit to the local economies in these key areas. Arizona, Texas are 2 of the key areas that are getting some of this money at this point. So first and foremost, there are going to be economic benefits, sort of direct economic benefits. But I think longer term, what the U.S. government is trying to accomplish here is to build a semiconductor industry that can help serve as a foundation for the innovations that you want to see in the economy going forward. Part of that is artificial intelligence. Part of it is quantum computing, electric vehicles. You want to make sure that you have access to these chips so that you can build those industries of the future.
Our Executive Editor for Asia Technology, Peter Elstrom there. More to come here on Daybreak Asia. This is Bloomberg.
Let's get the latest geopolitical news now. Senior Israeli officials say progress has been made in negotiations for a ceasefire in Gaza that would include the release of hostages and Palestinian prisoners. The defense minister says Israel has reached an appropriate point for difficult questions on returning hostages held by Hamas. Israeli media say a meeting of the Security Cabinet has been called for Tuesday. Germany is said to be forging ahead with a sweeping military overhaul costing as much as $7.6 billion. Sources say the ruling coalition wants to order hundreds of armoured transport vehicles and 2 additional Navy frigates. This is part of Germany's push to modernise its military following Russia's Ukraine invasion and will require approval from lawmakers in Parliament. Still to come, Janet Yellen. She got a very respectful hearing in China, but is it going to translate into the changes she wants in manufacturing and trade? We'll have analysis on this next with the Asia Society Policy Institute. This is Bloomberg. All right, got some breaking news out of Australia. It is consumer confidence figures for the month of April, or although a lack of confidence might be a better description, we're seeing a contraction of 2.4%. The reading itself, 82.4. Anything less than 100 denotes pessimists outweigh optimists, and yeah, they sure do. That's another sharp contraction in consumer confidence following the contraction we saw back in March, and that was what we got after the RBA really walked back the chances of a rate cut in Australia. The next meeting's not until early May, so consumers obviously not feeling too good. Family finances versus a year ago, that actually improved. But the view for the economy 1 year ahead, well, that contracted 2.7%. 5 years ahead, it's even worse, contracting 4.4%. Buying a major household item, well, that contracted 6.6%, and there's not a lot of confidence around buying a dwelling either. So another big contraction in consumer confidence, but at least it's a nice day, Heidi.
Let's get the latest when it comes to geopolitics, Paul. And Treasury Secretary Janet Yellen has wrapped up her 4-day visit to China, repeating her key message on what the US says is a build-up of industrial overcapacity.
China is now simply too large for the rest of the world to absorb this enormous capacity. Actions taken by the PRC today can shift world prices. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
Well, our next guest says Yellen's modest objectives for this trip underscore the complexities in US-China relations. Joining us now is Wendy Cutler, who's a Vice President at the Asia Society Policy Institute. Wendy, always great to have you with us, particularly around these sorts of events and meetings. And this sort of engagement, it's really hard to measure the deliverables, but it's important that it keeps happening.
Exactly. I mean, this is just another step in engaging with China. Even if we don't see eye to eye, it's better to talk than not to talk. But at the same time, we need to be prepared to take the actions necessary to deal with problems that they're creating, such as overcapacity.
The overcapacity issue is interesting, right? Because if you look at the data, there are some questions around what sectors Secretary Yellen might actually be talking about, and whether it is sort of an element of, the data that distorts what the reality of the overcapacity and what sort of products are being affected. But regardless of that, do you think it was noteworthy that she didn't rule out potentially import restrictions? And given the fact that the Chinese didn't really respond on, saying that they will take any sort of concrete measures to address these complaints?
Well, absolutely. I think she succeeded in raising this issue of grave concern to the most senior levels of the Chinese leadership. I was disappointed that the Chinese response seems to be very defensive and said things like we should just rely on market forces. But how ironic for China now to rely on market forces after they've been subsidizing industries like steel, like electric vehicles, like batteries and others for years and years with hundreds of billions of dollars.
You say that China's stance was defensive, but it certainly wasn't aggressive. Given how forthright Janet Yellen was with her criticism, are you surprised there hasn't been a bit stronger pushback from China?
No, but again, in the December work conference report in China, they did acknowledge that excess capacity was a challenge for them. And so in some ways, I saw the premier's comments as being a step back from that and just basically saying, like, don't worry, this is all going to work out and there's global demand for these products. And again, this is not just a U.S. problem because these exports are flooding markets all around the world, leading countries like Brazil, South Africa, Mexico to take measures against Chinese imports, unfairly traded imports.
Well, Janet Yellen says China's just too large to export its way to growth, and China disagrees with that position. So who's right?
Well, I think we're right. I think the supply and demand factors in China are just out of whack. They're taking measures to encourage more investment in manufacturing, and they're not doing enough to promote consumer demand. And I think that's one of the reasons why Secretary Yellen agreed to intensive consultations on balanced growth, the idea that they need to do more on the demand side and less on the production side. But the talks she launched, in my view, are kind of medium to long-term types of talks dealing with structural issues, and they could lead to delaying tactics by China. And so I think the U.S. needs to be very clear-eyed and very vigilant and take actions before we are impacted by a surge of Chinese imports. We waited too long to take measures against Chinese imports of steel, and frankly, our industry has never really recovered from the global overcapacity of Chinese steel all around the world.
Wendy, Janet Yellen's very well regarded and well liked in China. Do you think that this contributed to her ability to be able to speak very plainly? And can we expect that consistency of diplomatic engagement once her term ends, and also depending on what happens after November?
Well, I think given the fact that she is respected and she's viewed by the Chinese as the cabinet official they can work with, having sharp words on these issues come from her carry a lot of weight. But that said, I also am, I'll be watching to see if the Chinese try and use their relationship with her to kind of delay taking the kind of steps that are need to be taken. In my view, is in the coming months and in the next, whoever wins the presidential election or who's ever in the White House is going to have to deal with these issues, because we've seen this movie before with respect to solar imports, with respect to steel imports, and that is that if we don't take measures and we let these Chinese products, which are subsidized and priced in a predatory manner, come into our borders, our companies just cannot compete on a level playing field.
And of course, the new battlefield, if you will, is now over EV cars and batteries, right, for China. I do wonder how much capacity economically, domestically, does China have to sort of pull back here, given it's also dealing with the structural issues in its own economic transformation?
Well, clearly, look, China is a large market for EV consumption, but they're making millions more cars than Chinese consumers can consume. So therefore, there's no option for the thousands of electric vehicle companies in China that have received subsidies to just export in a manner where they don't really need to make profits. They just need to kind of get rid of the production that is hanging around in China, idling in parking lots.
Well, in a case of interesting timing, we've got the Russian Foreign Minister Sergei Lavrov arriving in Beijing the day that Janet Yellen leaves. How credible are Yellen's warnings when it comes to, just saying trying to watch it when it comes to supporting Russia's efforts in Ukraine?
Well, that's another tough message that she delivered. I'm sure her Chinese counterparts heard what she said, but whether they take any actions to address our concerns is an open question. And, given their close relationship with Russia and their growing exports to Russia, I think this is going to be an issue that's just going to get more difficult between the U.S. and China.
When do you think this could get complicated, as we've been sort of talking around potentially if there is a change in leadership in the United States in November? Going by past recent history, do you expect policy to remain more or less the same?
It's unclear. I think if President Biden succeeds in securing a second term, I think we will see a continuity in the policies that he's pursuing, including protecting our national security, but also promoting economic exchanges in the non-security area and looking for issues that affect the world and affect the region where we can work together cooperatively. If former President Trump wins, either we'll see a quick increase in tariffs across the board and against China, but we also may see a President Trump that wants to find to negotiate and to deal with China and to try and conclude the deal of all centuries with China. So I think with President Trump in the White House, we'd see a lot of unpredictability and volatility with respect to our relations with China as well as other countries.
All right, Wendy Cutler, Vice President at the Asia Society Policy Institute. Thanks so much for joining us, unpacking the takeaways from Janet Yellen's trip to China. Let's take a look at how we are tracking in markets that are open around the region. It is a mostly positive day. We've got the Nikkei better by 0.2% right now. We are keeping an eye on the yen. Not a huge amount of movement there at the moment, 151.86. The Kospi also in positive territory by 0.5%, while here in Australia we're also up by 0.5%. But leading the charge in Australia, this is interesting, materials, that sector better by 2% right now, and some interesting names in the mix as well, focusing in particularly on Fortescue Metals Group. This is a pure play iron ore, something of a bellwether for China demand as well, considering China is overwhelmingly its biggest customer. Fortescue better by 2.5%. We've seen that recovery in the iron ore price as well, back above $100 per tonne on encouraging data out of China and encouraging demand out of China as it's returned from its long weekend. So some of those iron ore names, other resources names, performing very strongly in Australia today. Plenty more to come on Daybreak Asia. This is Bloomberg.
I'll take a look at US Treasuries, which I think yields pretty close to the year's highs. Buyers are coming in despite the potential Fed rethink. Treasury yields at their highest levels of the year. Traders really deciding that 2 rate cuts from the Fed are likelier than 3 this year. And of course, earlier we heard from Neil Kashkari just commenting around the broad path of inflation still trending lower, that the labour market is not red hot, although still tight. That's from the Minneapolis Fed president, who had recently, he's not a voting member, I should point out as well, but had recently been commenting on the possibility that no easing at all would be required. But this kind of loss of faith is what we're seeing here, that the Fed will deliver on 3 quarter-point rate cuts. That was what was expected last month, has really been gathering pace in the last few trading sessions, given the strong March employment data. Next up, of course, Paul, we will be fixated on that CPI print.
Yes, indeed. That's coming up very soon in the US. Well, a new IMF report is warning of emerging risks in private credit markets, including liquidity and the strength of underlying borrowers. We spoke exclusively with Deputy Director Fabio Nattalucci about the fund's concerns.
The concern is one of rapid growth, right? So this is part of a trend that has been going on for decades from public to private markets, and there are certainly benefits, including for borrowers as well as for investors, but there are also vulnerabilities and possible risk. So we highlight one that has to do with the more risky borrowers. So those are smaller firms with more leverage, for example. Risk related to the liquidity mismatch between the assets and liabilities. That liquidity mismatch is less of a concern in this fund because they have very long committed capital. But there's a growing size going market to retail, for example. Leverage, it's another vulnerability. It's layers of leverage in the system. So this is the point. In case of like a prolonged economic downturn, we just have no idea how the system would operate.
I will be curious about that layer of leverage that you're finding, how many exactly there are. But I'm also curious, on the very surface here, just how much of a force is private credit becoming in the economy?
So the sector is a significant source of credit at this point. So it represents about 7% of the overall credit non-financial sector, and it's about 10% of bank credit. So it's the size that is relevant now, but also how rapidly it has grown, right? This is why we decided to focus on this sector. They are an important source of credit for firms. They are also an important source of returns for investors, right? Including like institutional investors. And so that's the reason why we look into this sector.
Now, there is some language here that I'm very curious about, this idea of potential systemic risks that could be created. You don't say that it is posing one now, per se, but what future worries do you have down the road?
So I think the two main concerns here, one is the interconnectedness, right? So in this ecosystem of private credit, we have not just private credit funds and other structures like BDCs. We have insurance companies as investors, but also we have private equity, and the link between private equity and insurance company, it's a growing feature in market, as well as the role that banks play. Banks are one of the providers of credit to this sector. So is this the link between the funds, the private equity, insurance companies, and banks in a world where we really don't have much data to use for assessing and monitoring this risk?
That's IMF Deputy Director Fabio Nattalucci speaking with our colleague Shanali Basik there. Well, we've had a lot of central bank action and we're looking forward to more this week, Heidi. One of the ones we've been watching is the Bank of Thailand. And, normally there's a bit of a separation of church and state, isn't there, when it comes to central banks? Politicians don't like to meddle, but the Thai Prime Minister's not shy, is he? He's calling for a 25 basis point cut to support the economy, but seems to be falling on deaf ears.
Yeah, he's saying that the BOT should cut the benchmark by 25 basis points to support the economy, whose expansion he estimated may have slowed below 1% in the first quarter. So we've been kind of hearing this pressure since the beginning of the year, right, from the Prime Minister Thavasin since the start of this year, ratcheting up his calls for the BOT to cut rates, which are at levels that are highest since 2013, I should say. The central bank pretty much snubbing those demands, saying that the economy's slow recovery is due to structural problems which they can't fix with monetary tools. So this kind of back and forth continues, but economists in the meantime ahead of that decision on April 10th, pretty split. 17 out of 24 economists we spoke to expecting that the Bank of Thailand would hold steady at 2.5%. The rest predicting a quarter-point cut, which if that eventuates would be the first BOT easing in 4 years. We have been watching a bit of weakness there when it comes to the baht after that rate cut call, or the call for them to put through more easing. So in terms of currencies, of course, we have seen this broad-based weakness across a lot of Asian currencies, the sort of a combination of what we've seen, a bit of strengthening in the US dollar, but also some of the volatility and uncertainty around the Chinese yuan as well. And we spoke to NAB earlier saying we may see still more volatility and more weakness across Asian FX until we get a bit more certainty from the PBOC in terms of what their line in the sand is for the yuan. Dollar yen at this point seeing a little bit of further weakness there, 151.86, just creeping towards that 152 level. A lot of economists now seeing potentially more flexibility around that 152 point as a point where we could see intervention, particularly given US CPI is out. It's probably more likely that we'll see policymakers waiting until afterwards before any kind of intervention is determined to be necessary. We did get some more verbal warnings from the Finance Minister, Suzuki, earlier this morning as well. A little bit of weakness there when it comes to trading in the won as well. But of course, stability and even a bit of strength there for some of these petro and commodities-related currencies. The Aussie dollar at 66 with the boost that we've seen in iron ore. And of course, you can get all of this and more on Bloomberg Radio as well. You can hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team broadcasting live from our studio in Hong Kong. You can listen in via the app, that's Radio Plus, or BloombergRadio.com. More ahead, this is Bloomberg.
Alibaba is cutting prices for cloud customers globally by as much as 59%. This is in a bid to win back customers in what's become a hotly contested market. Let's get more on this with Bloomberg Intelligence senior analyst Catherine Lim. So, Catherine, does this come as a surprise to you at all that Alibaba slashed cloud prices outside of China and by this much?
Well, you know, Paul, not a surprise at all, given that we have seen how the company have cut prices within China, which is a key market for the cloud unit. So, you know, for them to actually emulate that and slash prices outside of China doesn't come as a surprise. And really, it actually goes to show that the company is out to actually win the cloud, market, as well as tie that in together with its AI ambitions.
Do we see this as having an impact on the broader financial outlook for the company?
Well, this is one of many businesses within Alibaba, and well, not the biggest. It is one that, you know, most people would like to actually see Alibaba develop more of the new breakthroughs in technologies. So I guess in the near term, what we do have to watch out for is that there will likely be adjustments to the fiscal 2025 numbers, particularly now it seems like, you know, expectations of higher cloud margins in 2025 is, overly optimistic in my view, particularly given the price cuts that we have seen.
Yeah, Catherine, does this sort of invoke a potential response from some of Alibaba's competitors? Could we see further price cuts going forward?
Well, you know, we have seen that in some of the other companies, JD.com being one of many. So I wouldn't be surprised again to actually see the adjustments in prices by rivals, whether they're going to do it subtly or are they going to do it in a much bigger and more aggressive way, like what we have seen for JD.com. Well, it depends, on what comes through over the next couple of months.
Bloomberg Intelligence senior analyst Catherine Lim there. Price war could be brewing. Take a look at some of the other corporate stories we're tracking today. Another key headline that we're following, Tesla CEO Elon Musk says the shortage of chips spurred by explosive development in AI is starting to ease, but he is warning of new challenges ahead in the supply of transformers and other hardware. Musk spoke in a live discussion on his X platform with the Nordensbank Investment Management CEO Nikolai Tangen.
Last year it was about a chip supply. People could not get enough NVIDIA chips particularly. This year is starting to transition to a voltage transformer supply. If you look out a year or two, or certainly 3 years, it's just electricity availability. So those are constraints on the hardware side.
Bloomberg has learned that UBS is planning a stake swap to get a full ownership of its China platform. Sources say it's proposing to buy its remaining 33% stake in UBS Securities from Beijing state-owned assets management. In return, it would sell up to its entire 51% position in Credit Suisse's onshore arm. The development adds a new twist to the months-long bidding process, with Ant Group and Citadel earlier vying for the China venture. That is it for Daybreak Asia. Our markets coverage continues. The China Show is next.